Oil markets are pricing in a supply surge, while tanker traffic through the world's most critical choke point is collapsing. Guess what? The math ain't mathin'. Let's take a look at how the world has changed over the last 72 hours. Tanker traffic through the Strait of Hormuz is dropping. The US Strategic Petroleum Reserve is at half capacity and facing operational failure, according to a government watchdog. And oil markets are pricing in a supply surge. One of these things doesn't belong. Let's talk about whether we're headed to tank bottoms with or without the strait staying open. First, the landscape. Fresh U.S.-Iran strikes have tanker operations rethinking that 20-mile wide choke point that handles about 30% of seaborne oil. Zero Hedge reports traffic is plunging, which should matter because 20 million barrels per day normally flow through there. That's not a rounding error. Meanwhile, another report shows oil markets pricing in supply increases that aren't guaranteed. And the New York Post drops a bombshell. Our Strategic Petroleum Reserve is at 50% of normal levels with operational concerns. 3 data points. 1 question. Are we running out of oil to move? Ships willing to move it? Or both? Let's dig deeper. When tanker traffic drops through Hormuz, you'd expect tanker rates to surge. Basic supply and demand. Fewer ships willing to make the run means higher prices for those that do. We need to know if we're seeing that rate spike, because if we're not, it suggests demand itself is softening, or ships are finding alternative routes that take longer and cost more. Either scenario is bullish for oil prices long term, but the market isn't acting like it. Then there's the VLCC situation, very large crude carriers. The producer notes asks the right question. What's the balance of loaded versus unloaded ships? Are they deadheading to load, or are they loading and waiting? If VLCCs are sitting loaded in the Gulf, unable or unwilling to transit Hormuz, that's oil that's produced but not delivered. That creates a timing crunch and storage issues. If they're unloading and not picking up cargo, that suggests production disruptions or demand destruction. Now, layer in the Strategic Petrol Reserve situation. We're at half capacity. That's approximately 350 million barrels instead of 700 million barrels. The government watchdog warns of operational failure. Translation, we drained it fast during the political emergency of high gas prices, and now the infrastructure might not work properly if we need it. And here's the kicker. At current U.S. production rates of around 13 million barrels per day, we're not refilling it meaningfully. Can we import oil to refill SPR locations? Technically, yes, but that requires functional infrastructure, available supply, and willing sellers. 2 of those 3 are now question marks. Now, the second article notes markets are pricing in supply normalization, but the timeline keeps shifting. Initially, it was months. Now it's stretching longer. Nobody wants to commit to a date because the variables, Iranian disruptions, OPEC decisions, U.S. production rates, Chinese demand, they keep changing. They're all over the map. When markets price certainty where none exist, that's typically when you see violent corrections. Connect the dots. Reduced tanker willingness to transit Hormuz, plus half-empty strategic reserves, plus uncertainty supply timelines equals a potential supply crunch the market isn't pricing in. The mainstream coverage treats these as separate stories. They're not. They're 3 parts of the same risk equation. For the financially minded, this setup favors hard assets. Gold and silver typically spike when energy security becomes uncertain because energy instability creates inflation risk and geopolitical hedging. Crypto's reaction depends on whether it's trading as risk-on tech or digital gold. Sovereign debt gets messy because countries depend on energy imports, face physical pressure, while energy exporters gain leverage. So what do you do with this? Watch tanker rates and VLCC positioning closely over the next 2 weeks. If rates spike but traffic stays low, that's confirmation of a supply chain problem. If rates stay flat, that's demand destruction, which has different implications. Monitor SPR refill announcements, or lack thereof, and watch the spread between Brent and WTI crude, because if Hormuz stays restricted, that spread tells you how much the U.S. production advantage actually matters when global flows are disrupted. Are tank bottoms certain? Not yet, but we're in a scenario where multiple failure points exist simultaneously, and markets are priced for everything working out fine. That's not analysis, that's hope. Hope isn't a strategy when you're talking about energy security and half-empty strategic reserves during a Middle East escalation. Tomorrow, we'll be looking at whether central banks are positioned for an energy shock, or if they're still fighting the last war. Talk to you soon, and remember, be good or be good at it.